So what can you do about the higher mortgage interest rates? My name is David Giles, otherwise known as the Property Guy. Okay, so what can you do to overcome these higher mortgage interest rates? Perhaps you're already feeling the pain now. Maybe you're anxious about future payments when your current mortgage, comes off its fixed product. But when you're feeling worried, it's often quite hard to think clearly and be more decisive. So what I thought I would do is make a list of property related ideas on how you can increase your income and reduce your expenses. But I must say that not all of these ideas are going to work for everybody. Everybody's personal circumstances are different. So always feel free to drop me a message on here or send me an email for your specific circumstances. But on that note, this is a disclaimer alert. I'm not a mortgage broker or a financial advisor of any kind. So I'm not regulated or qualified to give you any financial advice. So anything I do say is based on my personal experiences, on what I've learnt as someone that's highly obsessive in learning everything about my own trade, which is estate agency and property investment and development, and all the interconnecting sectors that surround it, be that financial, legal, tax, planning, lettings, management, and all manner of property investment strategies. Okay, so number one, speak to your current mortgage lender. Now, I think always the first step should be to discuss the options available to you with your mortgage lender, because they may be able to offer you some temporary payment arrangements during a difficult time. For example, in the past, some lenders have been willing to switch your capital repayment mortgage to an interest-only mortgage. I mean, if you've got some savings, you could consider paying down some of the loan to improve the interest rate. Now, there's something called LTV, which stands for loan to value, and it's something that mortgage lenders assess to determine what rate they're willing to offer you. And typically, the way it works is the lower the loan against the equity value, then the better the interest rate will be. And the higher the loan is to the value of your property, the higher the rate will be. Quick example for you: if your property is worth £100,000 and your mortgage loan is £90,000, this means you have a 90% loan to value. Purely as an example, let's just say that the mortgage company were happy to offer you a 6% rate when you were at 90% LTV. Let's say you have £10,000 in savings that you'd be willing to pay down the mortgage to bring that mortgage down to £80,000. In that instance, your new loan to value will be 80%. So 80% loan, 20% equity. Now, it might be that that lender has a drop in their interest rates, let's just say 5% as an example, when you hit that 80% loan to value threshold. So now, instead of paying 6% on £90,000 loan, you're now paying 5% on an £80,000 loan. As I say, it's only an example, but that would save you £117 a month, basically by reducing the mortgage interest payments from £450 a month to £333 a month. But perhaps you don't have £10,000 or enough in savings to pay down your mortgage to actually get to that next LTV threshold to get the rate down. But maybe you've got family or friends that would be willing to lend you some money for the time being to do that. So over the next few months or years, as market conditions improve and say the property value gets higher, and actually over the course and passage of time improves the loan to value without having to pay any more money into it, therefore allowing you at some point in the future when things are better to refinance again and extract that money that friends or family were willing to pay and help you at that time, so you can pay them back. It's just an idea. Okay, idea number 2. So if your current mortgage company isn't willing to help, then you could speak to a mortgage broker, a good one, and I can put you in touch with the right one for your situation. You could look at refinancing with a new mortgage lender. Contrary to popular belief, a lot of people actually think once you pick a mortgage lender, that's it for 25, 30 years. It's far from the case. Some people regularly change their mortgage provider every 2 or 3 years. So you might be thinking, well, actually, I'm tied in, and if I change my mortgage company now, I'll have a penalty to pay. So that'd be crazy to consider changing mortgage company at this point. But actually, sometimes you just got to do the maths. Well, let's say you've got a £200,000 mortgage, and let's say there's a penalty on it of 1%, i.e. £2,000. So if you break that mortgage deal early, you got to pay that mortgage company £2,000. But what if you were to change the mortgage company now and there was a better rate available that would save you £2,000 a year for the next few years? Well, in the first year you'd have got your money back. So you see what I mean? Sometimes it doesn't make sense to just not do something for a penalty fee to pay when actually over the long term you're going to be much better financially. Idea number 3, call me crazy, but why not sell the property and rent yourself for a period of time? Now, for at least a decade, typically when you do like-for-like comparisons, rents have been higher than mortgages on the same property type. But that could be different now. I mean, rents are high, but mortgages and these mortgage interest rates in some instances are really hurting people, and you may very well be able to find somewhere to rent that is slightly cheaper than what your mortgage payments are right now. But even if not, even if it's negligible, or maybe even if it is slightly higher to rent than it is to pay your mortgage each month now, it still might take the pressure off, because if you sell the property, release a load of equity and put that in the bank, you could go from an equity-rich, cash-poor situation to a cash-rich, equity-poor situation, if you see what I mean. So rather than having no money each month and paying, let's say, mortgage is £1,000 a month, but then you start paying a higher rent of £1,200 a month, you're £200 a month worse off. So you think, David, what the bloody hell are you talking about? That's not going to save me money a month. But if it meant you put £100,000 in your bank for the time being, just to get you over this hump for a few months or maybe a year or two, maybe that's a good idea too. Maybe it's worth considering. And remember, these are just ideas at this point, and they're not going to suit everybody. But I'm just trying to give you all my ideas, and you can take them or leave them. This video is just a big, broad dump of ideas designed to help as many people as I can. Now, I haven't mentioned landlords at this point. So instead of selling your property, your rental investment, there is a strategy out there that would avoid you selling the property if that's not really what you wanted to do. That could significantly improve your monthly net figure. That is a very detailed subject, so if you want to know more about that, then just drop me a message on here or send me an email. Okay, idea number 4, why don't you sell your property and then buy another one that's cheaper? Remember, cheaper doesn't always mean smaller. So even if the market's slow, you might have a property that is really saleable that you could get a good price for today. And you might consider buying a different type of property that perhaps there isn't such high demand for, and therefore you could negotiate a good deal. So if you were to buy a cheaper property, then that would of course improve your loan to value, as mentioned earlier, because you'd be selling your property, buying a cheaper one, and therefore reducing your loan amount. Idea number 5, rent out your property and then you go and rent somewhere cheaper. Or you rent out your property and then you buy somewhere. It could be the case that your property could command a much higher rent than another rental property that you're willing to take tenancy on. And as I say, it may be the case that if you rent your property out, make a profit on against the mortgage payments, you may, depending on your personal and financial circumstances, be then able to buy another property as a home to live in. And it may seem a strange concept that if you're worried or struggling to pay for one mortgage, it might be that you're financially better off on a monthly basis by having two mortgages, in the event that you have surplus income after the renting out of your own property against how much the new additional second mortgage for your home may be. Again, guys, just another idea. Idea number 6, rent out a room. Now, you might not have a spare bedroom, but you might have a spare dining room that you eat in once a year or twice a year that you wouldn't mind renting out. And when I say wouldn't mind, some people don't like the idea of renting part of their property out to someone they don't know. You know, but if it gets you over a difficult time, you could be looking at getting anywhere between £500 a month to £1,200 a month. And I'm talking about, that's my area, that's the sort of Bournemouth and Poole area, depending on what type of property you live in or how big the bedroom is or whether it's got an ensuite or not. You know, that's a healthy sum of money that you could be receiving just from renting out a spare room. Maybe you've got 2 rooms or 3 spare rooms, and that could significantly change your position. And remember, it doesn't have to be forever. It could be for 6 months, could be a year, could be a couple of years. Whatever it needs to be to get you over this difficult period. Okay, number 7. Let's hope this is a lucky number 7 for some of you. This is advanced income strategies. And this is for landlords and homeowners alike that are considering the prospect of renting their own home or part of their own home out. But instead of doing it in the normal fashion, let's talk about some more advanced rental strategies. There's something called a HMO, which stands for Home of Multiple Occupancy, and it's when you rent out your property on a room by room basis rather than the whole to one household. Now, perhaps you've got a big house, maybe you've got a 4-bedroom house with a dining room and a study, so potentially 6 rooms you could rent out. Let's say on average those rooms could achieve £600 a month. That's 6 times 600, £3,600 a month. Now, typically room rent tenants will expect all bills included. So, but even then, if you would take off the council tax and utility bills, it could still be significantly higher than it would otherwise be renting to one family. Now, another advanced rental strategy is called serviced accommodation, otherwise known as Airbnb or such like. Now, this is typically when you rent out a fully furnished home or a room within a property on a short-term basis, akin to hotel-style like amenities. You know, I've seen some people earn as much in one weekend as they would otherwise in a whole month's normal rent. But before you start leaving chocolates on your pillows and turning your house into a hotel or renting out on a room by room basis, both those advanced strategies I mentioned, service accommodation and HMO, you're likely to need to get some authority from your mortgage lender that might not suit the current product you're on, and the local authority may require you to have planning permission or such like to before you even start changing how you use your property. Okay, and the last advanced rental strategy that I'm going to mention today is LHA. That is Local Housing Authority. Yes, that's right. I'm talking about housing benefit tenants, or aka universal credit tenants. Now, some people or landlords wouldn't like the prospect of this. However, there are some fantastic housing benefit and universal credit tenants out there. And it's all about the strategy I'm talking about. I'm going to try and condense it because it's quite a big subject. The strategy here is all about entitlement. So, quick example, let's say you've got a studio flat that's only worth £400 a month. But let's say a housing benefit / universal credit prospective tenant, they might have an entitlement of their housing element of, let's say, £550 a month. So rather than saying my flat is worth £400 a month, I'm going to put it on the market for £400 a month, you say what is the entitlement of a universal credit or housing benefit tenant for this property, and it would be, let's say in this example, £550 a month. So you're pricing the property for the entitlement of the LHA tenant, not pricing the property for theoretically what it is actually worth. But anyway, there are a lot of different variations to how this could work, not just in the example I've just given. So I'll leave it at those 7 ideas for now, but I'm sure there are a lot of other ways to save money, but those are my specific property related ones that I hope will help some of you. I'll leave Martin Lewis, the money saving expert, to teach you how to save money in other ways, but just think of me as the property saving expert. Okay guys, so don't suffer in silence. I hope that's been useful today. Reach out if you want to know any more or ask any specific questions about your situation. And remember, when you think property, think the property guy. I'm David Giles. I look forward to seeing you soon. See you on the other side.